This is a significant change for you, and I stress for people who aren't familiar with how you've called this market over the last year, you are no bet on stocks, no bet on high-yield credit. You've been bullish when it was the right time to be bullish, and now you've made a move to go in a different direction, Max. So let's take a step back and think about why. What is it that you see that tells you that this uncertainty will persist?
Yeah, good morning. Look, I think what the difference now is to perhaps a month or two ago. A month or two ago, we could have dismissed it as pretty much only consumer sentiment. We could have said this is pretty much driven by a political division. It's not something that is broad-based. It's just a couple of surveys, just a couple of soft data, particularly on the consumer side, and it's driven by one particular thing, so you can dismiss it. What's changed, I think, now is we see a much more sort of broader-based slowdown among all the soft and the survey data. You look at, for example, CEO confidence. We had the biggest one-month slump since September 2008. I think we all know what happened there. You know, you've got in the Philly Fed, you have the biggest two-month drop in new order expectations in history. That series goes back 55, almost 60 years. We've got the biggest two-month drop rate. You know, it's not just, it's on the labor market as well. You look at consumer expectations, consumer sentiment on labor market conditions, clearly looking for negative payrolls there. You look at challenger job cuts, clearly biggest jump there since COVID. So my concern is that people are focusing in the hard data. They're looking at the hard data from January, and they're saying, you know what, that's holding up, so let's dismiss the soft and the survey data. But I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off.
So underweight stocks, underweight high-yield credit, underweight investment-grade credit. Is this a bet then, Max, that this is going to show up in the hard data in the next few weeks and months?
Yes, absolutely. I think what we've done is essentially we've introduced a big sentiment and a big confidence shock into a US economy, which actually has been picking up and has been improving in the second half of last year. When you look, for example, at the labor market, remember payrolls, people were saying, well, it's just government and healthcare jobs. Well, in fact, when we look at the second half of last year, the net number of industries hiring was picking up. So even the labor market breadth was actually improving. And we've seen a lot of sequential numbers which actually were improving in the second half. So it's a bit like, you know, we've boarded a train that's been improving and been running in the second half of last year. And now we're suddenly introducing a confidence and a sentiment shock. So to me, I don't think this will take 3, 4, 5 months. I don't think this is going to be a recession that is going to be, you know, basically coming sometime in the second half. I do fear that we might get a pretty sharp slowdown in the data very early on and very, very soon.